Brydon then looks at the concept of the auditor's response to fraud when considering how to improve confidence in the auditor's work. And a lot of it is based on creating more clarity as to what the auditor's responsibilities are. He says that ISA 240 basically confuses, and he refers to ISA 240 as a balancing act, and that it actually lowers the expectations of users, what users are expecting of auditors. So he believes that it doesn't really help to clarify, it confuses auditor obligations. And the auditor obligation, as far as the auditor obligations are concerned, he refers to PwC's report, Future of Audit, that says that there's a clear demand from investors for greater detail about the risks, with a substantial majority of investors in favor of expanding the scope of the audit to include detecting fraud. So the first recommendation as far as this topic, fraud, is concerned, is that the regulator should amend ISA 240 to clarify that it is the obligation of an auditor to endeavour to detect material fraud in all reasonable ways. Now, that is probably already in ISA 240, but obviously not clear enough. So he says that it must be clarified that it is actually the obligation of an auditor to endeavour to detect material fraud in all reasonable ways. Then he recognizes in the second part of this chapter that the extent to which fraud can be detected is dependent on the quality and timeliness of management reporting and the openness of the corporate culture. So he says that it's not primarily the auditor's responsibility. Directors also have a responsibility. So his next recommendation is that directors should report on the actions that they have taken to fulfill their obligations to prevent and detect material fraud against the background of their own risk assessment. A lot of his report focuses on forensic skills, because he says what happens when fraud is actively suspected. When you go in an audit and you find that there's possibly fraud, then what happens? You send forensic accountants in to examine it in much greater depth. He says that auditors should start thinking like forensic accountants from the beginning. Auditors at the moment have this neutral mindset where they assume neither honesty or dishonesty. He says auditors need to learn to be able to apply the same mindset as forensic accountants, more suspicion of fraud than just being aware that there may be fraud. So our next recommendation is that training in both forensic accounting and fraud awareness must become part of the formal qualification and continuous learning process to practice as a financial statement auditor. So he's talking about the financial statement auditor section of the new profession, and they should have forensic accounting and fraud awareness training. And in developing qualifications for auditors of other areas of activity, not financial statements, parallel training should be established. He also recommends then that auditors need to communicate what they've done. So he says that the auditor's report should state explicitly the work performed to conclude whether the director's statement regarding the actions they have taken are appropriate. And the auditors should state what steps they have taken in there, and they're not part of the recommendation, but he says that this might include, for example, stating any material frauds of which the auditor has experience in companies in the same industry and what tests it applied to address the risk of a similar fraud having occurred. So the auditor's section on fraud should be more like an informative article about the auditor's experience and the auditor's approach and the risks and the principles and what the auditor has done and what the auditor has found. Then he also promotes a fraud register. He says there should be some sort of case study register that auditors can learn from. The regulators should maintain an open case study register detailing corporate frauds. Auditors should be obliged to, when they find a fraud, report it to the regulator, and then each material fraud should be noted in that case study, in that register, just anonymized, obviously, without naming names. Then in section 14.5, he looks at the judgments, post-fraud judgments. This is quite an important one, that often when auditors are judged after a fraud, then they are judged with hindsight. And with hindsight, a fraud or the red flags may appear obvious, but in real time it was not so obvious. So he's saying that in judging the potential culpability of the auditor, there needs to be some sort of framework that is trusted as impartial and reasonable. The suspicion that the regulator may want to what he calls scalp hunt. A suspicion that a regulator may have an interest in scalp hunting is not helpful. Confidence is essential. So somehow the confidence needs to be established that when auditors are judged, it will be judged objectively and not with the taking all hindsight into account. So the recommendation in this regard is that the regulator should establish an independent auditor fraud panel that would the results of investigations would be referred to that panel, and that panel should be able to levy sanctions on auditors. And the idea is that this panel would give auditors more confidence in the process, so that that would decrease the risk of court proceedings as well. And this is basically his anti-fraud package that he believes is going to help to restore confidence in auditors.